Check 1 2. 26. Good morning, everybody. I'm glad to see everybody at 8 o'clock this morning, bright-eyed and bushy-tailed, if you will. At this time, I'm going to call on Chairman Trey Rhodes to have the invocation for us.
Let us pray. Thank you, Lord, for this day, and thank you for a state and a nation that we can be here to come together to make decisions. We just ask that you be with us, give us courage and wisdom. Let us have a great day and a great meeting. In Christ's name we pray, amen.
Thank you. At this time, I'm going to call Chairman Bruce Williamson to go over a couple of housekeeping bills that we want to talk about today, and maybe we can get through House Bill 891 and House Bill 899. Mr. Chairman.
We'll start with the big one first. Everybody has a little energy. Thank you, Mr. Chairman, members of the committee. I bring for your consideration today House Bill 891, which is the Department of Banking and Finance's annual housekeeping bill. For the members of the committee that have been around for a while, you know that this has been a multi-year effort going on 7 or 8 years now that we've been streamlining and modernizing the banking code for the state of Georgia. I brag on the department because they, frankly, is Georgia Department of Banking and Finance. They're much closer to our financial institutions than are our national regulators, with whom they work very closely. But you can always get a phone call return. You might not get the answer you want, but you'll get the people that know what they're doing and walk you through any given issue. And the department regulates everything from credit unions, depository institutions, money service businesses, mortgage brokers, across the whole financial landscape in Georgia. And I do think they do a great job. But to delve into it, we do have a 50-page bill. And the reason it's so long is it's touching various aspects of a lot of these entities. But in the interest of making sure that all the members of the committee are fully informed and anyone watching online, we're just going to be deliberative about this and try to hit the major points. But so as I mentioned, it's the department's housekeeping bill. And those organizations that have basically helped review this bill include the Georgia Bankers Association, Community Bankers Association, the League of Southeastern Credit Unions, which is formerly known as Georgia Credit Union Affiliates, Mortgage Bankers Association, Georgia Financial Services Association, Georgia Installment Lenders Association, as well as some consumer protection organizations. So everyone had a place at the table again this year. Prior to addressing the individual sections of the bills, I did want to point out that a number of changes the bills are tied to this ongoing review process. And as a result of the department's review of its processes, this bill has a number of changes related to acquisitions and changes in controls involving banks and bank holding companies and those related application processes. More importantly, a number of changes in the bill for money service businesses are related to the model law developed by the Conference of State Bank Supervisors. Again, we're trying to modernize, streamline, and get consistent with our other states for simplification and modernization purposes. Another goal is to ensure consumer protection and prevent bad actors from entering the money transmission ecosystem. And this bill contains certain provisions in the model law dealing with control requirements. So I thought it'd be helpful, as we've done in years past, to take it from section by section. So I will launch into it, Mr. Chairman. The members of the committee, feel free to interrupt if there's any specific question as we move through these sections. And I'm going to warn you, because it's touching so many aspects, some of them we're going to be reviewing several sections at a time. So bear with me and please interrupt if you got questions. So
excuse me, one question. LC number 500267.
Correct.
And then the second one, LC 500259.
We're taking it one at a time. We are operating this House Bill 891 LC 500267.
Okay, thank you.
Section 1, generally the employees of the department are prohibited from borrowing from entities from which they have regulatory authority. This kind of hamstrings Department of Banking and Finance employees from getting access to certain loans. This bill does not eliminate the prohibition, but instead eliminates the requirement that permissible borrowings be reported, and it does not appear to serve any purpose. In addition, although generally prohibited from borrowing from regulated entities, the code currently permits employees to have a credit card with a limit of $10,000. The bill proposes to increase the limit to $25,000, but continue to require reporting of the credit card if it is issued by a regulated entity. So the department folks are regulating these entities, but this $10,000 limit on a credit card is pretty old limit, and we're just raising that to $25,000. Sections 2 through 4 is touching sections 15, 16, and actually 18 through 20 in parts. Is part of the review of changes in dealing with changes in control and acquisitions of banks and bank holding companies. The department has identified a number of revisions to the provisions, and the changes are as follows. The proposed language provides that in the event no person or entity controls 25% or more of a bank or holding company, then the largest shareholder over 10% will be subject to the change in control procedures. And basically that's the authorizations. The department wants to know who's operating these entities and whether or not they're good actors or bad actors in essence. The bill also provides that notice must be provided to the department in an out-of-state holding company if an out-of-state holding company requires a Georgia bank regulated by the department, but that the department does not need notice if the out-of-state holding company is requiring a bank not regulated by the department. So again, we're just cutting out some unnecessary steps. And I failed to introduce the Department of Banking and Finance's attorney, Bo Fears. Many of y'all know Bo, and Bo, please jump in and interrupt me if I'm failing to make sure that we're explaining this bill properly. Sections 5 and 6, this revision clarifies that changing control provisions apply to financial institutions other than banks. Specifically, the provisions apply to trust companies as well. We authorize trust companies in the state of Georgia that are non-depository institutions, but this would apply to them as well. You got a question?
Excuse me, we have a question.
Yes, sir. And I just want to understand something. I know we're raising from 10 to 25,000 on credit card. Quite a few years ago, I actually bought a car with a credit card, and there was a charge for going up to about $15,000. And there was a long reason of why I had to do that. But with that, do the banks create the charge over a certain amount, or is that the banking authority, or where does this charge come from? Because it was a good little bit to have the credit card buy this vehicle.
Yeah, I'm assuming that is nothing that's required by the banking department.
Okay.
So I think that charge is probably, so if you bought the vehicle and used a credit card, typically, as I understand, a lot of times what happens is the car company will actually impose that extra charge and that fee. So they absorb the cost of that charge, right? The fees that are being passed on to them by the credit card.
Just like I do on rental property, a 3.5% charge or something.
3.5 to 4%.
Okay. And I just want to clarify that. I kind of thought I knew that, but
That's a good example about on your rental property. What section we're on? 7. Yeah, moving on to section 7, the revisions here clarify that the specific definition of control only applies to this code section. And again, it's different from the definition of control for the rest of the article. Sections 8 through 10, the revisions here expands on current authorization for a corporation to be merged into a bank or trust company to also permit an LLC to be merged into a bank or trust company. A lot of financial institutions are now organized as LLCs, and prior to that, it typically been C Corps and S Corps. Sections 11 through 14 A representative office is a location operated by a bank that does not satisfy all the requirements to be a branch, but so you can think of like bank loan production offices or offices that are originating deposits. The department has reviewed its representative office processes and has identified a number of revisions. These changes are as follows. We got to provided that the home state laws of a national bank or an out-of-state bank apply to the activities at the location, unless the activities conflict with the Georgia state law, we won't bother with them unless they're in conflict with our laws. In addition, the proposed language expressly recognizes the permissibility of deposit production offices. Also, the revision codifies the federal law limitation providing that a loan production office can't close loan. You can't close, you can originate loans, but you can't close the loans at that location. And I'm assuming that's basically a customer protection issue.
Correct.
In addition, it strikes the language indicating that an agent of a bank or a holding company can open a representative office. The bill also provides that notice must be provided prior to the closing of a representative office. And finally, the bill eliminates repetitive or inconsistent language to be clear that representative offices must be registered with the department. Sections 15 through 17, proposed revision strikes language related to certain transactions that occurred prior to 1976. This is basically, it was back in 76 and before, there was some grandfathered positions on holding companies. And this is no longer needed, correct? That's the logic for that. Sections 16 and 22, the proposed revision corrects incorrect cross-referencing. So it's just basically some cleaning up language. Section 21, the proposed revision eliminates redundant language in that section as well. Sections 23 and 26, proposed revision requires the president of a newly formed credit union to be named at the organizational meeting, which has always been the case, but eliminates the requirement that the president has to be appointed annually by the board of directors. That's just, it's not necessary. Sections 24 and 29, Georgia law currently requires the department to approve credit unions offering third-party payment services such as checking accounts. This revision eliminates the requirement for approval from the department prior to offering these services. Again, that just aligns the treatment of credit unions along with the same treatment of banks. It's just sort of a parity issue. Section 25, the bill will eliminate a reference indicating that credit union members can vote by proxy, as the credit union members are expressly prohibited by voting by proxy, and this mimics federal legislation. Section 27, credit union boards are required to meet at least once during 10 months of the calendar year. This bill would permit credit unions to meet less frequently with the approval of the department. So you don't have to over-regulate good actors. This allows the department to spend their time on people that might need more regulatory and supervisory control. And again, that we have that same feature for regulating the banks in the state. So it gives a little bit more flexibility to credit unions. Section 28, our 2020 housekeeping bill made a number of changes to the credit union legal lending limit, including the combining of secured and unsecured obligations for the purpose of determining whether all of the transactions needed to be secured. This bill, that bill created sort of some unintended consequences for 4 of our state chartered credit unions, which are real small. They only have assets of $15 million or less, and it constrained them from being able to make this, frankly, small loans that they needed to make. So this bill would permit these smaller asset credit unions to not have to secure the small signature loan if a car loan already exists, so long as the total combined liability is $50,000 or less. So we have relatively low caps on the overall exposure for the credit union, but it gives them flexibility to make loans to their members. Sections 30 through 33, again, in the efforts to update and modernize the Conference of State Bank Supervisors, of which the department is a member, and money service business representatives recently developed a model law in order to harmonize definitions and requirements between various states. And this bill's doing that on behalf of Georgia.
Thank you. We have a question online.
Sure.
Representative Ward.
Good morning, and thank you, Chairman. My question goes back to section 14. We're talking about representative offices. Is there anything in this bill that prohibits someone from establishing a representative office in their home? And if not, so the representative offices will be a place to originate loans. What will protect the consumer's information if a representative office is established in someone's home?
I'm going to move here.
So a representative office is, it's going to be, is there anything that precludes it from being opened in a home? No, but it's incredibly unlikely, because what they would have to do is they'd have to register with us, and representative offices are normally branded, right? So it's going to have the bank's name on it, where you're going to accept customers. And then you can do, it's almost like you're a bank branch. It's like a bank branch light, except you don't take deposits. You can't disperse funds. It's really how it's utilized in a lot of circumstances by a bank is they open a location to try and determine whether or not that area will be fruitful for them to operate a full service branch. Now, do individuals in both the mortgage, so our licensed mortgage world, as well as in the bank and credit union space, can employees meet with individuals at a Dunkin' Donuts or at their home? Yes, they can, and they can take information. But that information, there are the expectation from the department is that all of our financial institutions have sort of robust protection procedures, cyber protections in place. And so that's kind of the answer to that. But I don't think the representative office piece per se really touches on that, because that's really sort of envisioning a bricks and mortar location.
Mm-hmm. Thank you.
Thank you. Does that answer your question, Representative?
It does.
Okay. Thank you, ma'am.
So that's
Can
good.
you-
That's a good question. Back to sections 30 through 33, I was leading in with the Conference of State Banking Supervisors, which department's a member, and money service businesses develop model law to harmonize definitions, which this bill does on behalf of the state of Georgia. So sections, and it's touching sections 31, 34, 36, and 44. The bill eliminates the requirements that certain required notices from licensed money service businesses, mortgage lenders and brokers, installment lenders be sent to the department via registered or certified mail. Instead of utilizing registered or certified mail, the department, this bill would require these notices be sent to it electronically. And the platform that's been built out over the last number of years is the multi-state licensing system, which is very efficient, and it's my understanding that it gives more protections to consumers as well, correct? Section 35, bill adds an exemption to the mortgage licensing laws as it carves out entities that hold mortgage loans for a limited period of time for the sole purpose of securitizing the mortgage. A very common practice in the mortgage industry is for individual mortgages to be pooled and then securities sold that draw on the mortgage payments of the individual mortgages. And typically these mortgages are held by trust or other entity for a short period of time before they're pooled together and ultimately securitized. Given that the exemption only applies to entities that hold loans for 7 days or less, there seems to be very little, if any, consumer exposure to the entities that are holding the loans, and thus an exemption from licensure is appropriate. In addition, the bill seeks to modernize a currently existing exemption As a general rule, a licensee must retain mortgage loan originators as employees and not independent contractors. A limited exception to this rule exists if the license is a subsidiary of a bank holding company or financial holding company and satisfies certain requirements. The exemption has not been utilized in over a decade, and this bill would authorize sophisticated financial companies that have a mortgage broker license to utilize independent contractors so long as a number of safeguards are in place, such as an increased bond, independent contractor working exclusively with the licensee, and the licensee having full and complete responsibility over the independent contractor's actions. So that is important to a number of businesses domiciled in Georgia. Sections 37 and 38, since the regulation of installing lending was transferred to the department in 2020, the department has identified a number of areas for potential revision. Basically, it's about dealing with GILA licensing. If you solicit, advertise, or offer, you have to get licensed. So this again is consumer protection, dealing with our Georgia Industrial Loan. What do we call it now? It used to be the Georgia Industrial Loan Association. Installment Loan Association. Section 30.
Excuse me, Mr. Chairman, we have a question online.
Okay.
Representative Will Wade.
Hey, good morning, Chairman. Thank you, Chairman. Quick question about the need on the licensure for the mortgage for the 7-day period. I'm not necessarily against that idea, but my question is if we have a completely unprecedented event like we did back when Lehman Brothers failed, would there be a reason to have a concern that if some type of an anomalous situation were to occur again, that somehow if there were people that were within that pooled period, that somehow they would be, lost in a transaction situation if everything were to shut down like it did back in the financial crisis? I'm not necessarily against it. I'm for reducing those windows of time and frustration for licensure, but I just want to make sure that we think through. We don't want to have an unintended consequence if something globally happens and then we just have, what happened back in the past. Just wanted to make sure that we had thought through that. It may be an incorrect concern, but I don't want to not ask the question if we haven't thought that through.
Yeah, thank you, Representative Wade. Licensure simply, it's sort of the idea, the concept behind it is consumer protection, right? And so here is where's the harm to the consumer, since those loans are held for a certain limited period of time. Let's say Lehman Brothers, there was something similar to that where you have a collapse where all of a sudden these trusts, they can't perform the securitization and they can't hold those loans and they can't sell the loans within that 7-day period, right? So they're not complying with the terms of the trust instrument. So I think how most of these trust instruments are structured, if you can't, securitization doesn't take place, then the documents kind of flow back to where they originated from, right? So whoever the lender, whoever originated the loan, it's pooled here. If you can't pull them together and get the securitization, then they're going to flow back, right? I think alternatively, if the agreement wasn't structured that way, then that entity, if it holds it for longer than 7 days, is required to get a license. So, that's sort of, so let's say the whole world implodes and they have to hold them, then those entities need to come to us and get a license.
Does that answer your question?
It does. I just want to make sure that I fully understood if there was going to be an unintended consumer risk. Thank you.
Thank you.
Another good question. Back to section 39, and this is important piece. Prior to the transfer of the GILA loans, the installment lending industry to the Department of Banking and Finance, which, if you recall, it was regulated by the insurance commissioner. The legislature brought it over under regulatory control to the Department of Banking and Finance. Was that last year or year before last?
Before last.
Yeah. Prior to that, Georgia law provided that each licensee, which was, I'm sorry, I want to make sure I get this stated correctly. Prior to the transfer of the regulation of the installment lending industry, the Department of Georgia law provided that each licensee, which was each location of an entity, could make a loan of up to $3,000. When the regulation of the industry was transferred to the department, the language was not revised, so the ability to make a loan of up to $3,000 was limited to each licensee, which under the current law included all of the locations operated by the entity. This bill would change the authorizing of a loan of up to $3,000 will return the industry to the status quo prior to this regulatory transfer of the bill, and importantly, ensure that more loans are subject to regulatory oversight by the department. So this is good from a regulatory and consumer protection standpoint. Moving on to sections 40, 41, 42, 43, and 45. Georgia law currently provides that licensees must remit a 3% tax on the interest collected by installment lenders. The implementation of the rule is overly complex and results in being one of the most frequently cited violations while the industry was regulated by the insurance commissioner. This bill eliminates the tax on interest provision and replaces it with a percentage fee based upon the gross loan amount at the time of funding. So in essence, it simplifies it and keeps people out of regulatory trouble through basically unintended regulatory trouble. Department believes that this simplification will reduce, if not eliminate, some of the historic issues with remitting funds to the state. The per loan fee percentage of 12.5 basis points should be revenue neutral based on the traditional remittances to the insurance commissioner and the projected remittances based on the quarterly loan filings remitted to the department by licensees. And this comes with the blessings of all the, again, the consumer protection folks are okay with it as far as the industry itself, because again, it just simplifies things for them. And finally, I'm sorry, 46. Oh, I skipped 46. I'm sorry, section 46. The bill provides that the ability of the department to issue a cease and desist order to a natural person employed by an installment lender capture any reason the department may take an action against an applicant or a licensee as that would clarify the scope of the department's enforcement authority and make clear that the department can take administrative action against an employee that commits prohibited acts. So basically, the department can weigh in against a single individual that's a bad actor. In section 47, simply this change would revise the reference to federal law to reference the correct citation, and that has overlap with sections 15, 16, and 31. That is a section by section breakdown of a bill that, again, that's just got a lot of moving parts in it, but none of it's really what I'm trying to say. None of it is concerning. It's just streamlining, modernizing, and with the overarching goal of protecting depositors' money and making sure that consumers are protected as well. So
Thank you, Mr.
happy to answer any questions.
Thank you, Mr. Chairman. Mr. Chairman Perkle, you have a question?
I do.
Okay.
Chair. Wow. Thank you, Mr. Chair. Thank you, Mr. Chair, for bringing this to us. Back on section 2. So I'm not going to provide a $10 word like Representative Wade did. Anomalous. That's feather in your cap, my friend. But in section 2, as it deals with control, is this to make our code section in line with others, with the federal government? Because I don't understand otherwise the rationale for the presumption of control, dropping it to between 10 and 25 if nobody has more than that. And if it brings us in line with the federal rules, then, you know, what do you do with that? But Otherwise, I'd like for you to explain why in this world we would need that.
So Chairman Perkle, thank you. Yes, what it does is it aligns it with the federal requirements. So we had an application and we really weren't aware that we were out of conformance with the federal requirements. We had an application that came in where there was the largest owners were like 24% or 23%. No one was over 25%. So we couldn't vet them for change in control purposes or get access. Now, the federal government was there and they looked at it. So we're just trying to fill that gap so that we will also have a seat at the table, and so that, we can review and provide our opinions on that change in control.
Okay, thank you.
Yeah.
Thank you, Mr. Chair.
Again, that's another good question, but happy to answer any other questions the committee might have.
Representative Ridley.
Yes, sir. He's got me. I think that the representative has done an excellent job enlightening us all on this bill, and at the proper time, I'd like to make a motion.
Thank you. Do we have any more discussion from the committee? We have a motion and a second. Yeah. Let me go over the rules real quick that were passed out a few minutes ago. The quorum for the banks and banking committee shall be 5 members, so we're good there. A bill or resolution or other matter shall be considered only after presentation by its author or by a legislator whom the principal author designates to do so, unless otherwise prescribed by the chairman. The chairman may establish subcommittees. The chairman, subcommittee chairman, and ex officio members of the committee may also serve as ex officio members. The committee and any subcommittee shall convene, recess, and adjourn upon the order of the chairman. The chairman shall determine the order in which measures are considered, and the rules of the House shall prevail in all matters not covered by committee rules. These rules may be amended upon motion duly made and subsequently approved at a meeting of the committee after regular notice of the change has been published. The secretary of the committee shall have a copy of these rules distributed to all members of the House. We have a motion and we have a second. Is there any discussion? Would you like to take a vote? Okay, all in favor of the motion of Representative Ridley, say aye. Aye. Any opposition?
Aye.
Aye.
Okay, we're good. Thank you. Representative Donahue, did you have 24?
Oh, that's mine.
Okay, thank you.
And the bill. All right, please, committee, I'd like to present House Bill 899, LC 50025-9ER. Again, this is a department bill. The reason this section of the bill was not included in the general housekeeping bill, it was just a recommendation by legislative council because we didn't want to do anything that is basically a subject matter issue, although it's very logically, and we probably could have kept it in the banking bill. Just wanted to be careful that we didn't have anything that could be deemed unconstitutional. So running it as a separate bill. The members of the committee probably have heard of the word of the acronym LIBOR. It stands for the London Interbank Offered Rate. And it was analogous to what we use more commonly, a Wall Street Journal prime rate. Back in 2012, and it's basically these rates were overnight loans, principally London banks. But back in 2012, during the whole heat of the meltdown, there was some definite misbehavior by some of the financial institutions that manipulated LIBOR to the detriment of consumers and businesses across the world. Regulatory agencies from every major country got involved, and the numerous meetings. And long story short, LIBOR is going away. Most of the financial institutions we have in Georgia have already backed out, stopped using any LIBOR pricing mechanisms in all their notes. But there are LIBOR is also used in not just banks lending money or the mortgage industry, but also it's tied into contracts. You could have a lease, for example, lease rates that could be tied back to LIBOR, and it might not pop up. Representative Washburn, you're a real estate guy. It might not pop up until the end of this lease term, and all of a sudden this lease calls for a renewal based on LIBOR. So the states of New York and ironically our next door neighbor Alabama have already passed laws that will provide a substitute pricing mechanism. And the whole industry is embraced. It's called SOFR. It's an acronym for Secured Overnight Financing Rate. It comes as a result of the Alternative Reference Rates Committee, which members include everything from the American Bankers Association, all of our major money center banks. It includes Fannie Mae, Freddie Mac for the mortgage industry, a lot of the securities companies. It includes Intercontinental Exchange, ICE, here, which is headquartered here in Atlanta. The life insurance industry is at the table, as well as on the consumer protection side, the Consumer Financial Protection Bureau is at the table. The Federal Deposit Insurance Corporation is at the table. Federal Housing Finance Agency, Federal Reserve Board of New York, and on. So basically, what this will do is when LIBOR completely goes away and a contract comes up for renewal, because there's no pricing there, it just disappears. So you've got a loan that's LIBOR plus 50 basis points. Well, this will provide the math, the model, the replacement pricing mechanism to stand in its stead. Now, if two parties, the borrower and the lender, agree to use another alternative, for example, Wall Street Journal published prime, that's fine. They have the flexibility to do that. But in absence of any other model, this bill would make it Georgia law, and there'd be safe harbors for the use of this pricing mechanism to step in the replacement of LIBOR. So it's a good bill. There's 4 or 5 other states. It's almost exact same wording, an intent to keep the pricing the same nationally. So I'd be happy to answer any questions. Hearing none, I'd ask for the committee's favorable consideration of this bill as well.
Do we have any questions from the committee? At this time, excuse me, 21.
The perfect time. I'd like to make a motion we pass.
Okay, thank you.
Second.
24, that was the second.
Yes, sir.
We have a motion and we have a second. Do we have any discussion? Any questions? All in favor of passage of House Bill 899 would say aye. Aye. All opposed?
Aye.
Bill carries. Thank you.
Thank you, Mr. Chairman.
Thank you, Mr. Chairman. Appreciate your due diligence, and we need to get you a large bottle of water. Is there any other business that needs to come before this committee?
That work okay?
Thank you.
Awesome.
Best one ever. Did you get those sheets from Leo?